Hi, team. It's Accounting Fundamentals, and it's time for us to make some adjustments to the trial balance. Now, we're far enough into this process. I need to step back. Let's do a quick recap based on where we've been and what's going on here. So we know Luca Baccioli set up this whole idea of the double entry accounting system, and it still carries forward through to today. Our journey has taken us through transactions and journaling and T accounts, visual representation to the general ledger. And then we built ourselves an unadjusted trial balance. And how we got there is we started way back at looking at business transactions, and we analyzed those transactions, and we understood that there's balance and harmony that's required throughout this accounting process. And we know that we use this DC Adler grid to help us understand and unpack all this accounting business. That DC Adler still to the rescue. We're going to use it some more. We took our transactions and we recognize this, right? Our journal worksheet. We know how the journal worksheet works, and we know what a chart of accounts is for a business, and we know how those account numbers carry forward. We know how we built out our traditional journal and the formatting and the processes that go into that journaling process. And we jumped into our T accounts, and the T accounts, that visual representation, and we applied that concept of normal balance, which is based on the DC Adler. Where does the assets and so on live under the debits or the credits column? We know those balances from here in the T accounts went into the general ledger, and the general ledger was that tracking process where we added all those transactions in, and we gave ourselves a little cheat based on putting a plus and a minus on top of the general ledger process. And this particular general ledger that we're looking at relates to equity, and equity falls under the credit side on DC Adler, and so we have a plus above the credit and a minus above the debit. And if it was a different type of account, we could switch the plus and the minus sign. You recall we use that process for helping us add and subtract the debits and credits in that balance total column that's on the far right-hand side in the general ledger. And we last left off with our trial balance unadjusted. And we know our trial balance gives us that snapshot moment in time, and it's a chance for us to test, do we actually have the balance that Luca Baccioli 400 some years ago required us to have in the whole accounting process? Now, just because we have balance doesn't mean we couldn't and didn't make mistakes. We could have made a mistake that somehow had its own balance in there, and we could still be wrong, but it is that first reference step. If we don't have balance in the trial balance, we go back and we make some adjustments and fix it. So the accounting cycle continues. And we're at a stage here where we could look at it a little differently. And this is just a visual representation that really shows the funneling effect, the narrowing, getting closer, getting more accurate, getting more refined as we step down. And we're coming down to at the trial balance at the bottom of this here. So we're getting much more focused and refined in the numbers and the recording and the transactions that we have. So we're at the stage where we need to create and post and recognize some adjusting entries based on what's been going on so far. And the word adjusting, right, that is related to our trial balance unadjusted. So we're at the stage here where we're going to make some adjustments coming out of that trial balance. Now, there's a lot going on this page, so just follow the screen here. So we know that the adjustments. Here's a really important point. Adjusting entries offset journal entries that have already been recorded. So we're going to create some adjusting entries that offset and create some sort of counterbalance to existing journal entries that are already recorded in the process. Top right-hand corner, follow the star. When we make an adjusting entry, we don't change the original journal entry. What we do is we create a brand new entry that will somehow impact the accounts that we need to adjust. And we can impact it through debits and credits, right? Debits on the left, credits on the right. So journal entries make adjustments. We don't change the original. We create a brand new journal entry. Oh, goody. We may have more journal entries coming. So, but all the way back to the very beginning, one more time. So watch where this is headed. So way back at the very beginning of the class, there was a lot of detail that came related to something called GAAP, GAAP, Generally Accepted Accounting Principles. And the GAAP concept had all these different kind of rule categories within GAAP, these generally accepted accounting principles. And we're going to capture this key one here called the matching principle. So GAAP, way back, the theory, deep dive into the theory for accounting is coming into play. And this matching principle applies to one of the very first questions that we had in the course talent section was talk about cash accounting and accrual accounting. And so this matching principle ties itself to the concept of accrual accounting, which we're going to start to unpack this a little bit more. It'll make more sense. So the purpose of this matching principle is to match revenues with the costs that it took to generate those revenues. We're selling lemonade. What we want to do is we want to match the revenue for the lemonade with the cost of the cups and the lemons and the sugar and everything else that goes into our lemonade. So here's a side-by-side real quick on cash versus accrual. This was in that discussion question from way back. So in the cash method of accounting, income is recognized when it's received. You make a sale, you get that income, you make a journal entry right there. And under cash, it recognizes expenses as they're paid. I received a delivery today. I paid for that delivery. That expense is going to get tracked in a journal entry today. Under the accrual accounting method, income is recorded in a journal entry when it's earned. So if I earned the income today but didn't get paid for it until 30 days from now, under the accrual counting method, I got to create a journal entry that says I earned the income today even though I haven't received it. And under expenses, it says that expenses are matched with revenue that they have generated. So if I bought some products today, I bought lemons today, I bought sugar today to make lemonade, then I don't necessarily take that cost and do something with that cost in a journal entry until I've got some revenue that goes with it. Cash versus accrual. So income received versus income earned, expenses paid versus revenue generated is a key piece of this cash versus accrual accounting. And here's a great example. Let's say follow the stars that are going to and the arrows are going to play out here. So we have a fire insurance example where we have fire insurance, and the fire insurance for the year costs $12,000. And so $12,000 is the cost of our annual fire insurance. Middle column, the cash accounting method, 2 stars. So let's say it's January and I accept the terms from the fire insurance company and said, yes, I'm going to pay you $12,000. It's January. I'm going to pay you the $12,000. Here's my $12,000 for the whole year. And January's transactions would record that $12,000 expense. That's it. Done. Paid. Journal entry in January. End of story. And at the very end of the year, looking back, we could see that we still paid $12,000 one time all the way back in January. Go to the last column, follow the 3 stars. Under the accrual counting method, things work a little differently. The $12,000 cost is going to be, because we want to match an expense, right, with different accounting periods. We want to match, right, with under accrual. So what's going to happen under the accrual is we're going to take $1,000 each month, and we're going to take that prepaid money. We're still paying $12,000 in January, but we're going to take that $1,000 over 12 months, $12,000, 12 months, $1,000. And every month in accounting, we're going to take out of that prepaid bucket, we're going to take $1,000 and drop it into January, $1,000 into February, and so on. So at the end of the year, we've still paid $12,000. We just account for it in different $1,000 increments, cash versus accrual. So accrual accounting, right? The income when it's earned and expenses get matched with revenue. So we're going to take some of that expense and match it, break it up, chunk it up to different periods of revenue in this accrual concept. And so accrual accounting, which most businesses use accrual accounting because it has more accuracy that goes with it. Accrual accounting requires adjusting entries. So we're starting a little series where we're going to be making adjusting entries and understanding what they are, when do we use them, how do we do them, and how do we build these new transaction journal entries that don't amend the original but create a brand new journal entry. So new series, it's all about adjusting entries. This first video is just to help us understand in this series kind of what is going on in the big picture. So objective met, end of video, more to come.